As you all know, a huge chunk of this channel's content is based around finance and investing. Because of that, I'm sure there's a ton of terms and phrases I use that you might not actually know the meaning of. Before I get too far down the rabbit hole on this channel, I decided that it'd be a good idea to make a video entirely on just the definitions and meanings of certain finance terms that you might hear me say. Over the past couple weeks, I've compiled a small list of words, which turned into a bigger list of words, which turned into a massively gigantic list of words that it would be impossible for me to fit all these in a 10-minute video. So my solution to this is to turn this video concept into an ongoing series. That way I can better categorize the terms for you, and that way I can keep these videos from being hours long. So far, I have almost 100 different terms to talk about, but in today's video, we're going to be focusing on just 8 of them. I'm going to put all of these videos into a playlist. That way anyone who's watching my finance videos and doesn't know some of the vocabulary or the terms that I use, they can use this playlist as a reference point and figure out exactly what I'm talking about more in depth. So before I ramble on about this too much, let's get right into what you're here for. What's good? My name is Caleb and welcome back to my channel. If this is your first time here, this channel is all about tips, tricks, and strategies to help harness your potential, enhance your life, and invest in yourself. So for more weekly content just like this, please consider subscribing. Now on to the video. Now real quick, before I get onto these terms, I'd first like to mention that all the definitions and meanings I'm going to give in this video are all under the context of finance. Some of these words have different definitions outside of the world of finance, but I first wanted to make that clear. Now the first word we got is capital. Capital is a term for financial assets, whether that be of a person, a company, or a corporation. Capital can include cash, other types of marketable wealth like securities, as well as production facilities and manufacturing equipment such as machines and factories. Capital can be a measurement of wealth too, so whenever you hear someone say market cap, what they're referring to is the total capital wealth of a company in the economic market. This is basically just the total combined price of all the stock shares of a company. Companies need a lot of capital in order to operate and turn a profit, and this comes in 3 major types. There's debt capital, equity capital, and working capital. A company can acquire capital through debt, which basically means that they borrow money from another person or another company, and they can use that to their own benefit, but they have to pay it back after a certain period of time. When you get a loan from the bank, you're acquiring debt capital because this money is yours to use, but it's not actually your money. Equity capital is similar to debt capital, except for instead of them letting you borrow money and then you have to pay it back afterwards, they're giving you money to keep indefinitely in return for a portion of the company's future profits. This is why you hear people on the TV show Shark Tank ask for a percentage of the company's equity in return for the money that they're giving out. They're saying, here, I'll give you $200,000, but I want 5% equity in your company, which basically just means they want 5% ownership of the company. What they're hoping to have happen is when that company succeeds in the future, they want that 5% equity that they have in the company to surpass the $200,000 that they initially gave out. Now lastly, we got working capital, and this is a company's most liquid assets meant for fulfilling day-to-day obligations. Working capital is pretty much just the current assets minus the current liabilities of a company. This is the amount of money left over after all employees are paid, all debts are returned, and all revenue is processed. Overall, capital is just money that a company has at their disposal in order to stay in operation. Now for the next term, investment. Investments are assets that are acquired with the goal of generating a profit. Investments are goods that aren't consumed, but rather used to create wealth in the future. Investments can include stocks, bonds, real estate properties, businesses, and many other things. All types of investments carry risk, which means they have the potential to lose value over time instead of gaining value. Investing is different than saving because saved money just sits around and does nothing, while investments are working for you to hopefully generate a profit in the future. Now I know I've probably said this word about 15 times throughout this video already, but the third word is assets. Assets are financial tools that are owned and used by a company, and this can be in the form of saved money, vehicles, buildings, equipment, other investments, and other businesses that they may own. If a print shop purchases a new printing machine, this counts as an asset because the new printing machine can help with the company's growth. A delivery van for this print shop also counts as an asset because it helps with the company's operations. To put it even more simply, if I'm a musician, all of my assets could be my notebook, the pens I write with, the studio I record in, all the equipment I use, and the money that I get from my record label. There's also intangible assets, and these are non-physical things like patents, copyrights, and trademarks. Investments in the company by other people or other companies also count as assets, and all of the assets added up and combined is the company's capital. Now on to the next term, volatility. Volatility is the measurement of change in value for an investment over a period of time. This measures the potential for an investment's value to go up or down. High volatility typically means big, rapid changes in value, whether that be up or down, and this is usually associated with higher risk, and low volatility means that there's barely any changes in value, and this is usually associated with lower risk. For example, if the stock market has big changes in value either up or down, this would be considered a volatile market. Typically when investing for retirement in the distant future, you want to have a focus on things with low volatility because these things are a lot more predictable. On the other hand, people who trade the stock market and are buying and selling shares of stocks all on the same day to make money are usually looking for stocks that have high volatility. Stock prices are a lot less predictable, but because of this, they have a much higher potential for reward compared to the more predictable investments. Pretty much with high risk, you get high reward, and with low risk, you get low reward. A stock chart with a smooth straight line would be low volatility, and a stock chart with a bunch of crazy spikes up and down would be considered high volatility. Volatility just represents how much an asset or investment's price swings up or down relative to the normal or average price. Now this leads perfectly into the next term, which is risk tolerance. Risk tolerance is the amount of volatility that an investor is willing to put up with their investments. To put it simply, if you panic and freak out when your investments lose value, you would have a low risk tolerance. If you don't mind short-term losses and you can remain in the game for the long haul and the potential for future gains, then you would have a high risk tolerance. Your age, investing goals, and comfort level all play a role in determining your tolerance for taking risks while investing. Someone with a high risk tolerance would be considered to be an aggressive investor, while someone with a low risk tolerance would be considered to be more of a conservative investor. Real quick, if you're finding value in this video so far, be sure to tap that like button down below, that way YouTube knows to recommend this video to others. And with that being said, let's continue. Now the next term is portfolio. A portfolio is a collection of investments like cash, stocks, and bonds. A portfolio is basically just a pie chart that shows you how your money is divided up amongst all your investments. A portfolio can also include real estate, art, and other financial assets too. Typically, a person's portfolio is managed by a money manager, a financial advisor, a brokerage, or even yourself. Having a portfolio that's diversified means that you're investing in a wide range of things. That way you're minimizing the risk and you're not just throwing all your money at like one stock, for example. So a hypothetical portfolio could look like 50% large company stocks like Apple and Amazon, 30% small company stocks like restaurants and drug companies, and 20% in bonds. The size of each part of your portfolio can help in determining the overall risk, and a portfolio's diversity can vary depending on the goals of the investor. The portfolio of an aggressive investor is going to look much different than the portfolio of a conservative investor. When you use money to invest or save for retirement, that money is going into a portfolio that tells the money how to divide itself amongst all the different things you're investing in. Now we got the next term, liability. Liabilities are anything that a person or company owes to other parties. Liabilities can include debts, payroll, warranties, and other services and expenses. If a company has a bunch of employees, the amount that gets paid to those employees counts as a liability towards the company. When a company receives an invoice for a new delivery of inventory, this also counts as a liability against the company until they pay it off. To put it even more simply, when you have an open tab at the bar, you're liable for the total amount that's on that tab until you pay the bill. Liability is also a term used to talk about insurance benefits. You can't go riding a skateboard through Walmart because their liability insurance doesn't cover them if you fall and break your neck in their store. However, they are liable for spills and slippery floors, which is why you see those mandatory wet floor signs in any private company that's accessible to the public. There's also long-term and short-term liabilities. An example of a long-term liability would be a 15-year mortgage, because this is an amount of money that you have to pay off to the bank over a really long period of time. An example of a short-term liability would be a company's payroll, because this is money that they owe to their employees on their weekly paychecks that they haven't yet paid out. For a single individual, all of your short-term liabilities could be your monthly bills, as another example. Typically, a successful company is one that has assets that generate enough income to surpass the amount of liabilities that they have. And if their liabilities become more than the total value of all their assets, this is typically a sign of a failing company. Now for the final word of the day, we got collateral. Collateral is an asset that a lender can keep as security for the loans that they give out. out. For example, if you take out a loan and you put up your car as collateral, this means that if you fail to pay off your loan in time, the bank can actually take your car and use your car to pay off the rest of the loan. Collateral is meant to help minimize the risk that lenders take when they give out loans. A form of collateral is also used in starter credit cards or secured credit cards, because basically you give the bank a deposit of a couple $100 for your credit line, and if you don't make your payments on time, then the bank will just keep this money. Typically, anything that is a financial asset can be used as collateral, and this includes bank accounts, cars, and also properties. Going back to the bar example, if you have an open tab that's left unpaid, they will keep your credit card behind the counter. That way if you accidentally leave and don't pay your bill, they basically have collateral so they don't lose money. Collateral is just an extra way that banks or lenders can hold you accountable for borrowing their money if they think you might be a risk to them. Now, I only included 8 terms in this video to keep it from being too long, but there's plenty more to come. Like I said, I plan to turn this into an ongoing series where I just take a batch of words that are kind of similar to each other and put them all in a video where I describe the meanings and definitions of the word. That way you can better understand what I'm talking about. If you want to follow along with this series, I'll put a link to the financial terms playlist down in the description below. And if you have any other recommendations for words or terms that you'd like me to define or explain, please leave a comment down below as well. Leave a like if you enjoyed the video, and be sure to hit that big fat red subscribe button down below with the little notification bell next to it. That way you get notified every single week when I release a new video. Lastly, be sure to check out my finance and credit cards playlist. I'll link it somewhere up here, and I'll also put it in the description down below as well. I hope y'all have a fantastic day. Thank you so much for watching, and I'll catch you in the next one.